On this hot sheet, we have a new wrinkle. We're diving into our first Freeform Friday, where I'm answering questions collected from you throughout the week, as well as some live ones. Today is Friday, August 18th, 2023. I'm Byron Lazine, and the hot sheet starts now. Welcome to the Hot Sheet, the only live daily housing show on the internet. We've been doing it since January of this year. And on this Friday, we have our new first wrinkle for the Hot Sheet. We're going to be answering questions collected throughout the week from Bobby, the producer. See, we call Bobby the producer by name only because on this show, I'm really producing all the content. So I wanted to give him an opportunity. I'm sure Bobby's smiling in the background. I wanted to give Bobby an opportunity to really curate the topics for this week. So he's collected some of his favorite comments from all of you this week. Of course, if you're jumping into the live stream now, let me know which market you're tuning in from, and feel free to post a question. I'll take some live questions as well. Soon enough, Bobby's working on allowing us to do call-ins on the show. So on Freeform Fridays, we're going to take calls from all of you here on the Hot Sheet. But before I get into your comments, it would be amiss if I didn't talk about the big news, which is that the 30-year fixed. I'm not excited about it, so don't I'm not getting joyful about the news. But the reality that the 30-year fixed hit not an all-time high, but a high for the last 20 plus years, the highest mark since December of 2020 yesterday when it hit 3.37. This also ties the high mark of last year. So tied for the high mark in over 20 years. 3 would be great. 737 on the 30-year fixed as we continue to see the 10-year bubble up. All right. This is just for context here. A look going all the way back on the 30-year fixed to the 1970s, highest in, again, over 20 years. But before 2000, rates at 7 or well above were part of the norm. So yesterday we hit 737. Also this week, the Freddie Mac 30-year fixed weekly survey coming in at 7.09. Can't remember the last time it was that high. You see all red on every metric. We've gone up every single day as of late, it feels, on the daily survey. Mortgage Banker Association as well as Freddie Mac are both in line with Mortgage News Daily's updates. Of course, there are some buyers, and you may be working with some, that are already getting quoted at 8% right now due to just their personal situation, their personal finance, and their their credit, of course. So there's going to be situations where we're already touching 8. But the big question is, are we heading towards 8 right now? This is the first real test of can the market handle 8%. Rates being at the highest level since the year 2000. At the beginning of the year, Logan Mogashami, who tracks this stuff better than almost anybody, I'd say, or better than anybody with Housing Wire, he had a projection at the beginning of the year that the 10-year would sit between 3.21 and 4.25. We've already broken that 4.25 mark. We've been at above 4.3. In fact, we sit at above that mark right now as I speak to you this minute. 4.276 on the 10-year. The 10-year continues to move up. Why? Because of a very strong economy. I know there's a comment. We're going to get into this a little bit more, a little bit deeper. But the economy is very strong. We've got to sell more bonds as well into the future. So that might be an indicator that they're going to go up a little bit later. But I just want to summarize Logan's thoughts in a piece today about the potential of 8% rates. And then we're going to get into this free form and take some of your comments here. So can mortgage rates hit 8%? Logan says, yes, they can. But it would require the economic data to stay firm. The economic data that is staying firm is we have a very strong jobs market. We had Atlanta Fed this week say that they're tracking GDP for the country in quarter 3 at 5.8%. That's banana hammock time. That's like unbelievable on GDP rate for one quarter. Okay, 5.8% is where they have the country coming in. Obviously, that's a projection. That's what they're tracking. That would be huge. So that's what he's talking about when he says the economic data staying firm means, yeah, these rates can go up to 8% because it means the 10-year is going to keep going up. Short term, as long as the economy outperforms, then 8% is in the works. So we continue to see good job report after good job report. We continue to see a rising GDP. We continue to see retail sales like we saw this week coming strong, a strong consumer. We know that we have low household finances for expense for most homeowners because 4 out of 10 homeowners don't have a mortgage. Many homeowners, over 90%, are less than a 6% 30-year fixed anyways. So they're locked into low finances. So they do have extra money to put into the economy. However, you can see the limits of mortgage rates now because the Federal Reserve has told us they believe their policy stance is restrictive. They've said that the last couple of meetings. They don't want to push the lever too much because one of their goals is to keep the Fed fund rate higher for longer. If they push it too much, of course, there's a belief that they'd have to start cutting faster than they want. They want to keep it and maintain it higher for longer. They're sending out signals that they kind of like where we're at. One thing that can change the Fed's mindset is the labor market breaking, but for now, they don't have to worry about that. Okay, if the labor market does break, the 30-year would actually start to drop because they would get into that situation where they'd have to start cutting that rate. All right, let's go into full mode, first ever Freeform Friday, and take some of the comments that Bobby has collected during the week, and we'll go through them one by one. If you've got some live questions, I'm going to be happy to take those as well. And coming soon, we're also going to have the call-in aspect to the show. So go ahead, Bobby, post the first comment. Of course, I'm going to have to be able to read these. Are there any factors in play? I'm going to just look at my other screen here that may cause the spread of the 10-year T-bill to 30-year rates to tighten. All right, so one of the big reasons, and actually Logan, I think he even mentioned it in his piece here. We talked about it with George Ratu, who's a former chief economist at Realtor.com, and he's also, now the chief economist at KCM. So one of the reasons why the spread is still, around 3 when it's normally around 1.7 would be the bank crisis earlier this year. So the bank crisis and the risk in mortgages right now, there's a perceived risk, like mortgages are more risky than other asset classes because of the affordability. Unfortunately, we're at an all-time low for housing affordability. So for new buyers, not the buyers that have bought in the last couple of years that did really well, but for buyers projecting out going forward, it's a bigger risk to give them that 30-year fixed. So the rate is going to be higher with and creating this spread. About 20% of the time, you have a spread that's higher than this normal 1.7 bips between the 10-year and the 30-year. There's belief that it would have been, a little bit reduced by now this year if we didn't have that bank crisis. So here's a good way to look at it. The spread between the 30-year fixed mortgage rate and the 10-year largely reflects the risk associated with investing in mortgage-backed securities. And basically that is a little bit riskier right now. And so there you go. There's a belief that it could start to tighten up. On average, it's 1.7 percentage points. Like I said, 170 basis points. It's been 300 basis points this year, which has made the relationship between the 10-year and the 30-year pretty easy to track. When you see that 10-year go up, you can kind of figure out where the 30-year is going to be later in the day. So about 21% of the time, the average spread was at least 200 basis points or more. So that's since 2000. All right. But it's ultimately a little bit more risky. And there's belief, and Logan says it, that if we continue to see strong economic data, you're going to see a higher 10-year for longer. So even if the relationship, if the 10-year continues to increase, even if the relationship starts to, between the 10-year and the 30-year, starts to shrink a little bit, you're going to see a higher 30-year. What was the spread when rates were 3%? The spread was, let's go back. It was the end. I want to say the end. Let's just take a look though. Spread of 10-year to, so I'll put it on the screen. Spread of 10-year to the 30-year. I want to say towards the end of the 3% rates, we were closer to this 300 basis point spread. In the beginning, it was more normalized. Let's take a look. Remember the 10-year got really low there for quite some time. Let's see if we can get that spread up. This is not showing us that. I'll pull that up. That's a great question. What was it when it was 3%? Now, obviously they were 3%. So are we looking at the end there, or are we looking at the beginning? That's what, I mean, let's look at it this way. I'll just look up the 10-year, 10-year treasury, which I already have up. So let me go to that. Not those shoes. Here we are. So here's the 10-year right now. 3 years ago on, let's just start at January 2021. The 10-year was at about 1%. Okay, 1.039. That's on January 2021. And if we look at, let me get rid of all these lines to make it easier. I'll go back 5 years. January 2021 for the 30-year fixed. Close enough. January 4th, 2.76. So you see there that that's about 275 basis points. That, again, towards the end of the 3% run that we had, it had started to widen. Okay, if we go back to now, let's go before pandemic. Let's take out this time frame in October, November 2018. That's when we had an interest rate increase. But let's go to, let's go to like 2020. So January 2nd, I've got 2020 was at 3.75. And where were we at that point? Why don't you give me all the way to 2020 here? All right, I'm gonna have to go to CNBC Wall Street Journal. Thanks a lot. We'll go over there. That's fine. 10-year Treasury CNBC should pop right up. Here it is. Let's go back a little bit further than what Wall Street Journal was going to let me do. Okay, 2000. Of course, it's going to make me use my finger on the iPad now. All right, so let's call that 1.8. And we had us over here. Now I can't even remember where we were. I think we were at 2020, January 1st, 2020. We were at 3.75 and 1.8. That's much closer to 200 basis points at the beginning of 2020. So it's this relationship has gotten wider during the last 3 years. High uncertainty, economic uncertainty, a lot of volatility, abnormal times. Only 20% of the time do you see a spread that gets up over 200. these have been abnormal times for quite some time. So in the world of 3% interest rates, we've seen both the 200 and less spread, and we've also seen the closer to 300 spread, 300 basis points that we're seeing right now. What would you be telling buyers now? Still buy now, refinance later if they can? I would never tell a buyer that ever in my life. And I'm sorry, Jackson, if you're new to the hot sheet or new to health, I've been adamantly against that advice. I mean, think about this. Think about all the agents that gave that advice out in 2022 when rates started going up. You want to refinance today? They had an interest rate when they were giving that advice out at 5%. They're like, don't worry, buy and refi later. What was the whole thing? Marry the house, date the rate, some nonsense like that. When you just use these coined phrases like, are you thinking about buying or selling? When you use these garbage phrases, you sound like a garbage salesperson. And so I'm not saying that you did, Jackson, give that advice out, but yeah, I would never give that advice out about refinancing later. I mean, here's a reason why this is terrible, advice. If we go back in the history, have we seen, this is the highest since 2000 that we've experienced. But have we not seen decades where the interest rate is in the 8s and 9s and even higher at times, right? I mean, I'll take these 17s out because that was the high inflation time, which is kind of what we're going through now. I don't know if inflation is going to reemerge. You could see the rates get back out of control, but 9s and 8s and 7s. Yeah. I mean, this is something that has happened in the past. So what I would tell a buyer now, and I'll bring up the chart and I'll put it into our daily download. Of course, if you're in BAMX, you get access to all the hot sheet daily downloads. You can get into BAMX by using code HOT. You get 10% off. If you want more out of our content, definitely join us in BAMX. Okay. But this is what I would tell the buyer. Listen, are you going to be in the house 7 years, 10 years, 12 years? Like the average homeowner right now, which one is it going to be? Nobody's buying for a year. So is it 7, 10 or 12? Oh, it's probably about 10. Okay. About 10 years. Let's look at the last 40 years and break them up into decades because it's easy to do. In the 1990s, homeowners appreciated over 30% on their value. So far in the 2020s, homeowners have appreciated 40%. If they weren't listening to idiots like Reventure on YouTube, who told them in 2020 that the market was going to crash, and they went out there and locked into those low rates, they're already up 40%. In the 2010s, they were up over 45%. In the 2000s, when we had the great financial crisis, the mortgage collapse, the biggest real estate meltdown of all time, in the year 2000, in the decade of the 2000s, homeowners are up almost 48%. Okay, so when you are a buyer and a homeowner for 10 years, your appreciation is going to go up. We can agree on that. Now, it comes down to, can you afford the payment today? And that's a real decision that we have to sit down and make. Can you afford the payment today? Do you want to sacrifice? What does it look like for you and your family to sacrifice 15 minutes outside of the community you really want to be in to capitalize on that type of appreciation to be able to afford the monthly payment? Because listen, if it is just about the location and the payment, then the decision might be to rent, because they may find a rent in that location that they really want to be at the payment that they can afford. And, because rents are going to be cheaper than buying right now. I mean, look at this one that'll drop into the daily download as well today. I mean, this is the reality, right? So I don't want to trick people. I don't want to fool people. How much home can you buy with a $2,500 monthly mortgage payment, You could buy a $750,000 home. Today, you can buy a $440,000 home with the same $2,500 payment. That's the reality of what's going on. I can't hide from the numbers. I can't tell them that they're going to be able to flip these numbers in 2 years on some refi. I don't know that. I'm in the belief that rates are going to be higher for longer. So what's the payment that you can afford? Understand that if you hold real estate long term, we're going to be a massive winner on the appreciation. How much can you give up to be a homeowner? Put yourself in the position to be 44 times X wealthier than the renter. Or is it about the short term payment and location? Then we may have to look at the rental option. Listen, the home values aren't crashing. And Logan Motoshami from Housing Wire said it on CNBC this morning. Don't expect, with inventory levels where they are, values to crash. Not going to happen. But real estate has crashed. And real estate's going to continue its crash going into the fourth quarter. Transactions are going down because of this, because of what we're talking about here. Values aren't going anywhere. Strong jobs market, low inventory. 4 out of 10 homeowners own their house outright. Baby boomers control 1/7 of the world's wealth. Baby boomers have $18 trillion of real estate. A lot of them don't have a mortgage. A lot of them have these huge, significant retirements. They're the biggest buyer. A lot of reasons why home values aren't going down. But the market has crashed in a way where now we're faced with 4 million annual home sales. And remember, Zillow said if we get to an 8% interest rate, that number could get down to 3.3 million home sales. Remember fourth quarter of last year. And then everybody was like, oh, January, it's like the lights went off and or the lights switched back on and the buyers are back. That was called seasonality. The season of this fourth quarter will be worse than last fourth quarter. I'm not a pessimist. I'm looking at the data. We've got 75% of the mortgage demand that we had last year. It's down 25% is another way to say that. We're going to have less people that can afford homes because homes are worth more money this year going into fourth quarter than they were last year in almost every market. Rates are higher for longer. And we've burned through some of those buyers that can actually afford what's going on right now. So it's what the crash of real estate is less transactions, not prices. And I want to be really cautious about the advice that I'm giving in that environment, that you may not be able to refinance later. You're going to need, if your plan is, I'm going to own this house for 7, 10, 12 years like the average homeowner, you should be going in with the mindset that I'm going to be able to afford this mortgage payment that I'm committing to. Now, the reality is a lot of people's income is going up. So do you think it's going to get easier or harder for you to afford this mortgage payment? A great Phil Jones line would be, well, do you and your partner envision making more money or less money over the next 10 years? Well, we're probably going to make more money. Okay, so does this high payment, is it affordable today? Yeah, we can afford it today. Okay, so then will it get easier or harder to afford it over the next 10 years as your appreciation goes up probably over 40%, right? And that's maybe where you can get some people off the edge. I wouldn't get them off the edge on a hope and dream of refinancing. 3% isn't coming back. Here's another way to look at that. This is going back into the 1970s. We had a 1 or 2 year moment in time of 3%. Now, will 3% never come back? No. I mean, I'm sure at some point it will. But every time we have these sharp declines, I wish I had this screenshotted. I don't. But every time we have these sharp declines, like right here, sharp decline in rates. What did we have? An extended period of higher. Another little sharp decline, an extended period of higher. Another little sharp decline, an extended period of higher. Okay. So we had this sharp decline coming into, where we sit. I'm going to go here 1 year. I don't want to go 1 year. We'll go 5 years. We'll go back to, oh boy, what did I do? What did I do? All right, I'm going to get off of that. But you know what I'm saying? We got a short decline here on the 30-year fixed, a steep decline. Now we've popped back up, and just going off of historical trends, it looks like higher for longer. So I want to stay away from that. Bobby, what else do we got? What else are we cooking with here on this free form Friday all over the place? Let me know in the comments if you like the free form Friday. Why do you think Rocket is on a new hiring bid for loan officers? I did look this up because I'm like, that's an interesting comment that I don't know much about. And the Detroit-based lender plans to recruit up to 500 LOs by the end of 2023. Connie Kim from Housing Wire wrote this piece. It's more than triple the current local LO pool. Okay. Now, it also goes on to say that Housing Wire previously reported that Detroit-based lender hired about 150 remote local loan officers. And so they're trying, the CEO of Rocket, which Rocket is the biggest, mortgage provider in the country, says that they're going local here. They want to get local with their business as opposed to just kind of being seen as this call center. In his eyes, this indicates that because they've had an increase in referral numbers in the second quarter, indicates that realtors are interested in what we as Rocket have to offer. Let me know in the comments if you agree. And passing that on to their clients, we have been excited to see that increase. I know Rocket Homes has been happy to see it. Rocket Homes, of course, is an opportunity for agents to get leads. So you might want to look into that in your market. So it seems like the real estate community is reacting positively to this particular program. Now, because of the Rocket Homes division where they're generating leads for realtors, they want to get some realtors that are located in this space. So why do I think that they're doing this? I think we all know that local wins right now. Branding matters, right? All of the pessimism that I have about the fourth quarter with the data that I have available to me the last couple of months tells me that brand is going to win. It always is the case. If Mark Davis is in the chat, 1,000 watt, he would certainly agree. We did that survey with 1,000 watt, recently, and like 9 out of 10 agents are optimistic about the next 6 months. And I'm a little worried about that because I don't know what, we're going into a seasonality time of transactions going lower. Preparation and brand would be the best form of optimism to me. And so Rocket understands this. Get closer to the customer, be local. And here's the other thing. It doesn't cost them a lot of money to go and get salespeople. Okay. It's not a huge investment for a company like Rocket to put 500 local LOs out there. And the other thing that I thought of was, it's NFL football season about to be around the corner. I mean, what do you always see on TVs, during the NFL's Rocket loans commercials. So maybe they think they're going to get a boost of demand by pumping those NFL playoff, NFL Sunday opener commercials. But yeah, I think going local as agents or lenders, whoever, whatever segment of the real estate business that you're in right now, going deep local is going to be your hedge against a real estate transaction crash that has happened and continues to happen. It's going to be a long time before transactions rebound. So what's the best hedge against that is investing in brand while you're seeing others in your market either recede out of the business or recede on their investments into their brand. I'd go real deep on that at a local level. Bobby, do we have anything else on this free form Friday or any live comments? I'm going to have to figure this one out, Bobby, because I'm in trouble reading. I'll go to the other screen. Jennifer. So this is Phoebe Reyes says, I'm over here like, come on, the MLS ransom cyber attack is no joke. Yeah, it isn't. We wrote about this on Now Bam. I got to say, I don't have a ton of information on it, other than what I've been reading. The great piece on Now Bam, of course, that you can check this out, nowbam.com. Yeah, I mean, here's my takeaway on what's happening. This can happen to anybody's MLS. This can, by the way, can happen to anybody's CRM. Make sure you have good insurance I don't have an assurance affiliate for you. If I did, I'd shout it out on this on business insurance. But this can happen to anybody's CRM too, like where you get hacked and could get in a lot of sticky water there. Is it sticky? I don't think it's sticky water, but sticky situation. All right, here's my takeaway: is that if you're going into a consumer, whether it be a seller or a buy side situation, and only offering them MLS tools. I'm going to list your home on the MLS. I'm going to set you up on an MLS home search. These are things that are going to be automated. So I'm thinking more transaction coordinators really got to show value in different ways. White glove service, being close to the customer, a connection to our customers as listing coordinators if they're going to be valuable in the next 5 years, because AI is going to be able to upload data into the MLS. Okay. If you think that's a great part of your job, uploading photos or uploading data, you'll be out of one soon. Okay. And then on the flip side, offering a buyer an MLS search, which 8 other agents have already offered them, and they're probably on 3 of the same search through the MLS, is also another really, bad bet to stand out. You're commoditizing yourself and all of that. So if the MLS is your only tool, I understand it might be one of the main tools in the tool belt, but if it's the only tool, you're going to be holding yourself back. It goes back to what we just talked about. Brand has got to break through locally. If you can't use the MLS, but you've got the biggest brand in the community, you're the most well-known, you're the most connected at the clubs and everything else, well, people are going to seek you out to be able to sell or transact when they have a need. Okay. They're going to go to safety, and safety is the best brand. All right, Bobby, I think we did a decent job on Freeform Friday. I'll give Bobby, pick some good comments there. I'll give Bobby nobody in the comments. I see Bobby posting, relocate the whole BAM team to Long Island. That is never going to happen. Long Island is, I just don't know about it. I mean, I know about it. I know enough not to go there very often. Bobby's sitting in Long Island right now. I don't know where this came from. Relocate the whole BAM team to Long Island. I could promise you that will never, ever, ever happen. But the whole BAM team will be in Naples, Florida on September 20th. BAMX members get 25% off to BAM Camp, the most epic conference we've ever done. It's the first one we've ever done, but I mean, look at this speaker lineup. So many great creators believe in what we're doing. The camp counselors, we've got over 20 speakers for this event, or exactly 20, according to this slide. And it's just going to be absolutely incredible. You can get 25% off of the ticket. The ticket price did just go up, but you can still get 25% off of the ticket sale right now by being a BAMX member. You can get 10% off of being a BAMX member by using code HOT. And if you're making a last minute decision to come to Dallas, we've got BAM Bash Tuesday night in Dallas, Tom Ferry Summit Tuesday through Thursday. I can't wait for that. I'm flying out Sunday. I can't wait to be out there. So hit me up if you're going to be out there. Your last minute ticket for that, use code PRBAMSS. Let me know in the comments, especially if you're on the replay. Let me know in the comments what you think of Freeform Friday. Maybe I gotta do more questions. Maybe that's going to be some feedback. I probably went on a little too long on some of these questions, but maybe we can get more questions rapid fire. And just wait. Bobby has promised me, even though he is dreaming about moving BAM to Long Island, which will never happen, he has promised me we're going to do live call-ins here on Friday. So I cannot wait for that. Freeform Friday, the newest segment of the hot sheet. We've got some other segments, some new wrinkles coming up to the hot sheet as well. Appreciate you guys. Consider subscribing to the channel if you haven't done it. Have a great weekend. I'll see you back Monday from Dallas. Until then, toodaloo.